Samiran, good to have you on board. Given the kind of state of affairs that we're seeing, particularly when it comes to crude oil prices, as India is an importer, how are you looking at this, extreme volatility in crude prices impacting the import bill?
Good morning, everyone. Uh, yes, you are right that this is a very critical component of our overall import bill, and the sensitivity is also quite high. So we estimate that for every $10 increase in crude prices, our current account deficit widens by about $14 billion. So we obviously have to be very conscious on this front. As a house, Citi has a view that this oil price volatility is more temporary in nature. As the year progresses, the demand supply dynamics will improve, and that will lead oil prices to drop below $70 by the end of the year. And with that view, we had estimated that India's current account deficit will be below 2% of GDP, which is quite okay. But just hypothetically, if oil stays around current levels, then also we are looking at around 2.5 to 3% of GDP current account deficit. It's not impossible to manage that, but would create more headwinds for sure.
With the Reserve Bank as well talking about how inflation is going to be at about 4.5% next year, what kind of a risk other than oil prices do you see to inflation? What kind of steps do you believe the Reserve Bank can take in order to mitigate this?
So obviously that RBI's forecast that you are talking of 4.5% average inflation for fiscal year 23, it builds in a lot of good news not only in the front of oil, but also in the form of food prices. Global food prices have gone up, but Indian food prices have shown a completely different dynamics based on local factors. So RBI probably expects that softness in food prices to continue next year as well. And lastly, they're also probably building in the fact that economic growth is not going to pick up in a hurry in India. The way we economists put it is that the output gap is likely to stay negative all through fiscal year 23. And that means the demand side inflation would also probably not rear its ugly head anytime soon. So if all these assumptions are correct, then we can stay closer to RBI's forecast. But if any of these assumptions turn out to be incorrect, then we are probably looking at a higher inflation trajectory next year. But we suspect that till average inflation is around 5% or so, RBI will not be in a hurry to at all tighten policy. Only if inflation inches higher than that, we might start seeing some normalization, that too most likely in second half of fiscal year 23 when the first repo rate hike we are penciling in.
Are we going through a crunch time? One side there is inflation, one side there is crude, credit offtake has not picked up, rural demand is not that great. So what we thought, let's say, would be the shape of the economy in September, October, November 2021, we are nowhere close to what the consensus bullish view was. In fact, every bullish thesis is completely getting challenged.
Yes, Nico, you are very right on that. In fact, even for us, we have done two GDP growth revisions in consecutive months of January and February, which is slightly unusual. And these are downward revisions to our numbers. That's primarily stemming from the fact that the quarter, October-December quarter, was a quarter of two halves. In the first half, till the festive season was there, we saw a very decent economic recovery. But once the festive season was behind us, we saw some flattening in the recovery curve. And then the Omicron wave came in late December and January, which again pushed us back for a little. And now in February, we are returning back to the pre-Omicron levels. But what is happening essentially is that there are repeated supply side shocks that we are seeing, and unanticipated supply side shocks as we are recovering from Omicron. We now have this Russia-Ukraine conflict as another headwind for growth. So that uninterrupted economic recovery path that we were building in our forecast, that doesn't seem to be working fully. Unfortunately, economists are not in a great position to forecast these supply side shocks. So we will keep on tweaking our GDP growth numbers based on the extent of these shocks. But I must say that this forecast revision downward for the last couple of months have not been something that we had thought of, as you said, even 3-4 months back.
Samiran, now let's look at the bullish aspect. Hopefully, we will get the first clean year of a non-COVID non-COVID year. We've got an IT sector which is now really growing. We've got demand which is coming back in real estate. The urban Indian is feeling excited because of the new jobs and how things have changed, at least on the salary front. What are the chances that growth, normalization because of a non-COVID wave, and the uptick in service sector largely led by IT and somewhere contribution coming from real estate could change the could help us revive and regain the bullish thesis?
So what I will be most hopeful of, and if our forecast on this is correct, is a private capex recovery in the latter part of the year. I think the factors that you are mentioning, these are all going to contribute to that private capex recovery, because every other precondition for a capex recovery is in place other than capacity utilization levels. So when this sort of urban demand picks up, maybe we see some stability in the rural demand, we see some real estate kind of demand coming in. All these things will add on to this capacity utilization increase. And once we reach that 75-80% on capacity utilization, I suspect that we will be in a position for a pretty strong private capex recovery. And if that happens, then only we will get a more sustainable GDP growth over the next 3 to 5 years. If we only get these sort of 1 or 2, 3 sporadic idiosyncratic factors, that might give me some boost for 1 year, but it will not be able to have a more durable, broad-based recovery going forward.
Samiran, why has rupee been so resilient? And again, if I look at the absolute comparison and the relative comparison, with so much which is going wrong suddenly on the macro front, FIs are going, crude is on a boil, demand is slowing down, dollar index is strengthening. I'm pleasantly surprised that rupee has not broken below 80.
So, Nikunj, what is going on here is that, in our view, RBI is not using the exchange rate as a policy instrument as much as the previous RBI would have done, neither on the appreciation side nor on the depreciation side. And part of the reason probably could be that there are anyway n number of uncertainties in the market. They don't want to throw another degree of uncertainty coming from the exchange rate side. And that's why probably trying to keep it within a narrow range. And you rightly mentioned about the dollar. I think the RBI is trying to keep the currency against that 40 currency basket of real effective exchange rate in a narrow range. And what has helped them is the fact that the inflation differential between India and rest of the world is now much lower. In fact, with some countries, our inflation is lower than the developed world as well. In that sort of a scenario, you don't need to depreciate the currency to bridge the inflation differential, which is generally the case for India. And that's why they've been able to keep the nominal exchange rate relatively flattish without affecting our export competitiveness in a big way. I think it's a prudent strategy given where we are on the risk curve. And I expect RBI to hold on to this. And they have the ability to do it because they're sitting on $630 billion of reserves. Let me also just add that despite all the negative BOP factors that you mentioned, whether it is oil prices or whether it is the capital outflow, the BOP is still flattish, not really big negative. The true test will be in the April-June quarter when seasonally BOP is anyway weaker. If we see a more meaningful BOP deterioration in that period, then whether RBI will intervene to that extent to stem that rupee depreciation in that period is open to question.
To your mind, though, Samiran, given that the balance of payments currently is healthy enough, and the central bank has managed to mitigate and hold the currency stable, to your mind, but which are the big risks to India's currency?
Yeah, the big risk is actually the dollar index in some sense. If for some reason dollar strengthens more, and that happens because sometimes dollar is used as the risk haven currency as well. So if with this risk off environment, if dollar starts strengthening, or if 2 months down the line we find that the Fed tightening is much faster than the other developed markets, and that's why dollar strengthens on the back of that, then RBI will probably be looking at shifting this 74 to 76 range and looking at a new range for the currency. I don't think they will allow any runaway depreciation for INR under any circumstances. Well, people obviously in hypothetical scenarios talk about oil prices at whatever 130, $150. We'll see how things behave in those times. But at this moment, I will primarily be focusing on how the dollar index moves rather than anything else to see whether we see any further extension of this USD INR range.
Makes sense. Samiran, great to have you on the show. Join in with all that perspective. Good speaking with you.
Thank you.